again to tonight's Zoom at 8. My name is Julianne Peterson, and I'm with Old Capital Lending. And we are a premier provider of debt for multifamily. Now, if you're working on something that's not multifamily, we can certainly help you with that. It's probably going to be a CMBS or it's going to be a bank loan, and we do those. We are a large broker, so we can provide bank, bridge, CMBS, agency. So all of those we can get done for you. We've been doing this for 36 years, and Zoom at 8 came on board about 3.5 years ago. So we are excited that there are so many of you that come to us every Tuesday night. So that's awesome. I appreciate that. Well, let's get on with the show. So today I have asked Kyle Candlish to come speak to us about 1031 alternatives. I have been in 7 1031 exchanges, and they're not easy. They're very challenging. And so some of you may say, I'm not doing that. I'm not going there. Give me some alternatives. So tonight, we're going to hear from Kyle, who actually was a former professional golfer. Can you believe that? And now he's a tax nerd. And through the last several years, his goal has been to find unique, effective strategies that people may not have heard of and educate his clients on them. Through hundreds and thousands of hours of research, he has developed partnerships with numerous tax professionals that have helped save clients billions in taxes. This is the guy you want to hear. So we're ready to hear from Kyle of these alternatives. Here's the deal. Kyle lives in the great state of California that has rolling blackouts. And unfortunately, his house got hit with it. So he's not supposed to have any electricity for the next several hours. Unfortunately,
I got it back. I actually got it back.
It's back on now.
I'd have to go reset the router. I think that's why I can't get internet, but I actually have it back.
Okay, perfect. Okay, awesome. So Kyle's back. If everybody would do me a favor and go to the right-hand side of your screen and go to view and go to speaker. So now we can give Kyle all of our attention. And instead of watching people shuffle papers, you can give Kyle all your attention, and he can give you the details of some options for you. Because again, 1031s can be very stressful. In fact, I had a 1031 and my father-in-law shows up and he is going to live in our house. And I thought, I'm in the middle of a 1031. This can't happen. So I've lived through it. I understand it. And you know what? You may not have a 1031, but maybe one of your investors does. And so be a resource. Be a resource to your clients. And you might say, hey, I don't know all about this, but I heard Kyle, and Kyle can walk us through this. And so now you've got another person on your team who can help you with that. So Kyle, welcome to Zoom at 8. How are you?
I am doing fantastic now that I actually have some air conditioning. House was getting a little warm.
My, oh my.
Yes. But before I start off, I'd like to do a poll and see what alternatives people in the group know of in terms of for not having to do a 1031 exchange. So what other options could you utilize? You could put in the chat.
Is it possible to maybe say like one is what an alternative and number two is that alternative? Is that possible?
Well, I'm trying to see what other options individuals know. I mean, I know Mark could put one in terms of what he does to reduce capital gains tax, but I'm curious if anyone else knows of other strategies.
There it is, paying a lot of taxes. That's his option. That's Bill Gross's lazy man 1031. Ethan?
Opportunity zone.
Oh yeah, opportunity zone.
Okay.
Who else?
All right. Those, yes. I do like the pay more taxes. So those are definitely options. I will, as I hinted to Mark Gross, you could use cost segregation as a way to reduce capital gains tax.
Yep.
But what is the main reason we like to do cost segregation? Julie, do you know?
Well, it's bonus depreciation. So we depreciate it, we accelerate the depreciation in the first year. We get a big lump sum,
Which goes against what?
goes against our taxes.
Our income taxes, right?
Correct.
So why utilize something for capital gains when you don't have to, when you want to use it for income taxes? So what I do is I specialize in 3 set principles that have their own different spins. So 1 is a charitable partnership. 2 would be business interest. 3 would be business insurance. Now, charitable partnerships will be anything that creates a charitable deduction. So most people, individuals, for their income taxes will donate clothing, TVs, they'll send it to Salvation Army, Goodwill, and they will get a deduction for it. That will normally be about 50% against your adjusted gross income. Those are considered non-cash charitable contributions. Other contributions that would fall under that category would be historical conservation easements. So I heard one of the guests was we did a 100-year-old building. There's a chance that that building could fall under a historical building. As long as it's under the federal regulations, you're good. When you have just cities or states or county that have it covered, most groups do not want to deal with it because the city, state, or county wants special interest on it. So with these buildings, you will get $2.45 in tax deductions for every dollar spent, up to 50% of your adjusted gross income. So the benefits of this will be that you can reduce income, you can reduce capital gains. Most individuals on this strategy will take it for the income part, because most of the time income tax is higher than capital gains tax, but it varies on the individual. Another option would be land conservation easements. These are under the IRS Dirty Dozen list because of the abuse. Most groups will take this strategy and take a higher multiple than what would be said. So you want to purchase a piece of land, and you go and check and see what your best option is to make the most amount of money. And you want to take conservative numbers. Most people, most of us syndicators, when they're projecting something, they will go conservative numbers because they want to under promise, over deliver. Same way, when you get someone that says that there's an 8, 9, 10x multiple, that's when you're probably going to get an IRS audit, and that's not going to turn out good. This strategy, again, will go against 50% of your adjusted gross income. Another option could be, and most people may have heard of these, is charitable remainders trusts or charitable lead trusts. These are when an individual ends up donating the property that they have before sale into a trust. There's various strategies that I've seen in terms of they've made the beneficiary, the kids, as a charitable contribution. I get a little hesitant when I see that, because I don't know how you can actually legally defend your kids being a charity. I mean, you might be able to with all the stuff given to them, but I don't know if you can necessarily actually defend that. But I have seen that. The goal with the charitable remainder trust is that you want to receive monthly payments for a long period of time. Most of the time, you'll see them done as CRATs, so charitable remainder annuity trusts, where you get annuity payments for 20 years. After that, the remainder goes to a charity. or if you happen to pass away inside the 20 years, your heirs, that is when it gets donated to the charity. So it's either 20 years or death, whichever one is technically it's going to actually be longer. So it's going to be 20 years if you pass away. It's going to be after 20 years if it's inside the 20 years, or if you pass away outside 20 years, it's going to be donated. Charitable Leads Trust is going to work the exact opposite. The charity is going to get it, and then when you pass away, your beneficiaries get it. Another strategy, and this is for high-end individuals that we utilize, would be charitable LLCs. Some of these have negative connotations from certain individuals, again, abusing this strategy. But what you're going to end up doing is gifting your piece. So we could use an example of an individual that has just made $1 million off a syndication. They have a capital gains hit of $1 million. They will gift that interest to a charity to create their 99% deduction. When they gift,
say that about the 99%, is it 99% deduction?
yes, I'm sorry. So business entities, real property, stocks, businesses, real estate are real properties they consider, and you get a 99% deduction. You will end up gifting that $1 million capital gains, your interest in it. So let's just say it's 15%. Well, we'll do easy. 10% interest of the deal. You're gifting your 10% interest to the charity, creates the deduction. That's where you then will have it to where you're not going to have to pay taxes upon the sale. Everything for a remainder trust, leads trust, charitable LLC, tax work, all has to be done before the sale. So if you're working with a syndication, you want to know, hey, you want to hear from your syndicator, I'm going to sell this property. We're going to sell this property in the future. We're going to list it. That's when you want to gift your interest over to the charity. The charity is then going to take the property because they don't pay taxes on the sale.
And we're all excited to hear what's next, but I don't hear Kyle. Kyle, where are you? I see everybody else is good, but there you are, Kyle.
Okay, my internet just popped back on. I see it on my phone. That's why. Did I freeze?
Yeah, you froze, and
Okay.
we missed you at no. You don't pay any taxes, no taxes, and then that was it.
Oh, the charity doesn't pay any taxes. Yes.
Yeah.
So we're then going to set up a trust, which sets up which we had Natalie speak a while back. This is going to be a grantor's trust. You are going to be the beneficiary and the trustee. That trust is going to set up an investment LLC, which comes in a loan agreement with the charity on the money that's available. You're going to use the Fed applicable rate for your interest, and the charity is going to loan the money to the investment LLC. That's the way that you create a liquidity event on your money. So it's a complicated process for a high-end individual, but it will reduce income tax, capital gains tax. It's a well-oiled machine once set up and running. But it's an option for individuals on a high-end basis. For business interests, business interest is really interesting. I know a lot of syndicators will like to get loans that are just interest-only payments because that's a tax deduction. Again, that would be considered business interest. If you invest in businesses, you can get deductions. So there's a business that you see that wants to be, that you really like, you can invest your money in the business, and that will go against your gains because it's a capital loss for that year. That's basically what cost segregation does, and the same thing. That's where you get your negative K1s. There are many groups that like to take their own spin on getting negative K1s. Some will use it in a form of creating losses through business insurance for your business. And I've actually seen about 3 or 4 in the last 6 months on these. One will use capital losses from individuals from companies that participate in trade. These will create your losses by you becoming a partnership in it. They'll just transfer over the losses. Can vary in terms of if you have business partners. And you'll get a negative K1 through this strategy, which will then go against your losses. Everything that's done in terms of a business interest is a way of interpretation of the tax code. Charitable contributions are charitable contributions. You have your non-cash, you have your cash, you have your business entities. There's no real interpretation. It's pretty straightforward. It's finding ways where you can actually legally defend what you want to do for business interests. So for your cost segregation, you can defend that I have these components that need to be accelerated on the depreciation, and you can deduct it. Where I've seen individuals that get very aggressive on their cost segregation. They'll do a cost segregation study in the beginning and they'll do one at the end. Not sure why they do it fully at the end. There's a certain reason. I kind of stay away from those because I'm not trying to completely milk the whole system, for lack of a better terminology. I'm trying to create deductions that we are entitled to, that we are allowed to have. So some groups, depending on your level, will charge on it. There's a group that will, through creating business insurance, which creates a loss, they'll do it for an individual that has 100,000 to 2,000 capital gains. Those strategies are good. What their whole goal though is to really write life insurance. There's ways we can get around that to where we can create the deduction. We make them happy with the life insurance, and yet we still have it to where you can reinvest that right away. I've told them hundreds of times, I really wish you would just charge for this, because individuals will would probably prefer paying for it than just going the life insurance route, but they take a cut of the life insurance, so that's how they get paid. I don't think it's the best business strategy, but that's their strategy.
So let's just kind of go back, because I want to make sure everybody's tracking. So when I think of charitable partnerships or donations, I feel like you're giving them and you get the deduction once. So here's my $1 million, and you get it once. You write it off that year, it's done.
Yes.
Right?
Yes.
When we go into business interest, it's like doing a syndication where you're taking that like a 1031 and you're putting it into a business. Is that correct? And you'll get the K1s and you'll continue. It's a relationship. It is an ongoing business, correct?
Yeah, the business will keep going, correct. Some are just one-time deals. They're basically kind of like with the cost segregation study. You have in, obviously, if there's enough depreciation that can carry over for the next couple of years, you get that. You could do the same thing with certain business interests. But some of these groups make it to where you just have to maybe mitigate the gain for that year or the income for that year, and then you can redo it again the next year. That's normally how land conservation easements are going to work. Historical conservation easements. Now you could donate, say you only have $200,000 of gain, you could donate to where it's 300,000 in terms of to deduct because you know you're going to have another gain the following year. So you can plan because those deductions carry over 15 years. So you can just keep deducting if you'd like. You could do a big lump sum if you wanted, and then just keep letting it kind of ride.
Okay, so wait, go back, because that was a key element, what you just said.
Yes.
Is that on the 15 years, is that just for the land conservation?
For land and historical buildings. Yes, 15 years.
15 years. So while you're getting that, like the bonus depreciation, cost segregation, you get that all up front, or you can do it on for an ongoing basis. That is a big deal. So can we walk through an example on that? You had said 300,000, but I'm going to get $500,000 back in a syndication. So first of all, when do we, I know it's coming, it's up for sale, I'm going to get my money. Charles gets these all the time. So Charles decides, hey, I need to figure out, when do I call you? And then when do we take it to, which way do we go? And so kind of walk us through that.
Yeah. So on a gain that high, you would probably want to talk to me before, because the strategy, we could utilize certain strategies where we can either defer or reduce the tax for at least 15 years. Let's just say hypothetically though, you didn't talk to me. We still have options. So I was talking about the historical conservation easements or the land conservation easements.
Mm-hmm.
Those must be in place by December 31st of the year that you have the gain. So let's just say it happened. We can say it happened in June. Okay. We need to make sure that we have everything filed by December 31st. Now, I will say most groups, so one of the funds I work with for the historical buildings, once their fund is closed, it's closed. So they just opened it. So we're in September, they just opened it. It'll probably close mid-October, maybe early November. That's what they'll, so that's how long it'll be open. That's kind of your timing. For the historic, or for the land conservation easements, actually one of the groups that I work with is only doing one this year because there's actually legislation in Congress to limit the multiple. They only want to limit it 2 to 1. So it doesn't matter if you could make a 6x multiple on it. They want to limit it to 2 to 1. So they're only doing that because that law, if it gets passed, will be in place next year, or at the earliest, it'll be in place comes November, and they will have had their fund closed by then. So they're not going to do it. But they have other groups that are doing it. So that's when, in a sense, to answer your question, we prefer before you have the sale, because our whole playbook is open. When we get you after, there's other choices. So, I mean, for example, with the charitable LLC, we can only mitigate up to 60% of it. You're not going to pay as much taxes still, but we can mitigate up to 60% of it. With the land conservation easements or the historical conservation easements, we can mitigate up to 50% of your adjusted gross income. With one other strategy we call it a strategic ownership program. That's where we're purchasing or we're buying into an interest of a group that has billions in capital losses, and we're getting those capital losses. We can do it, but for the most part, the group doesn't want to do anything less than a $70,000 contribution. So we need about 700,000 in gains because it's a 10 to 1 multiple. And that's going to be a 15 and a half year deferral that can be renewed on when the term is up, it can be renewed, where you could then just keep deferring it indefinitely, where you could get the potential step up in basis like you do for 1031 exchanges.
Now, my question to you is 1031, I go for one property, doesn't work. I go to the second one, that doesn't go. Would I say, okay, Kyle, give me that third one and I'm going to go with the charitable contributions? Do I need to say exactly where it's going on that last one? Or do I try all of my 1031 ones that I've identified? And if that doesn't work, then I come to you.
Yeah, I would say just exhaust it.
Okay.
Because preferably it'd be either you want to go the 1031 route or you want to go the alternatives. But if we've gone to the part that you've exhausted, you wanted to go the 1031 exchange, you like 1031s, and 1031s definitely have their place. The part of the reason why I actually started searching for alternatives was I never liked the 45 days.
Yeah.
I'm not really worried about the 180. I'm worried about the 45 days of identifying. And I didn't like the fact that your basis didn't restart. Again, we love cost segregation. So I want to get the full benefits of cost segregation. I want to start off on a new property. I want my basis to restart. And I want to be able to get the full benefits of cost segregation. So I'm not going to want to have, take $1 million property and step up and go to a $2 million property where I only say have $1 million in basis that I can use for the cost segregation. That's part of the reason why I've picked other strategies that allow me to utilize other tax tools like cost segregation.
Okay, so for those of us that have, let's say, 70 to 120,000.
Yeah.
We don't find, there's nothing that's coming up that, doesn't really fit where we want to go. And we don't want to get hit with these taxes. We can come to you and we would talk about the different options.
Yes.
Would you separate them or do you take the whole amount? Does it have to stay in one or can you separate it? Can I put some in charitable partnerships and some in business interest?
I could, at that level, you're going to take one of the choices.
Okay.
Because of the standpoint that it's just, we want to make everything pencil. So, we don't want you just using a strategy if basically it's going to cost you the same amount of money that you were going to pay your taxes. That just doesn't make any sense. Why utilize it? You might as, it's less work. Wow. There's California telling me to conserve my energy. So
it's killing me too.
There you go.
There we go.
So we're going to want to make sure that, we don't need the work and we don't need you to go through a hassle if you're not going to see a benefit of it. So now, let's just say you have 100,000 in gains.
Yeah.
And you have, let's say 150,000 in income. Okay. We're probably going to look at some kind of charitable partnership because we can actually wipe out some of that W-2 income, which will actually be taxed at a higher rate than your capital gains. So we're going to take the whole picture of we're going to take your whole tax picture and see what we can do, where there's a reason why Congress keeps trying to attack high long-term capital gains rates, because they don't get as much money from them as they do from income tax. There's ways you can defer, there's ways you can reduce. So that's why they keep taxing it, because they know they don't get as much money from that. So we might as well use that as what we're going to pay for taxes instead of the income tax part.
So the whole recapture on a syndication can be quite scary.
Yeah.
For people.
Yeah.
And if you're not a real estate professional, it also, that recapture is held, right? You don't get the bonus depreciation. It goes on the shelf
Right.
until you recapture it. So
Right.
everybody understand this. This is not my area of expertise, but we have two people in the house that understand this. If you're not a real estate professional, you're a limited partner. That cost segregation is not given to you at your first year of taxes. It's put on the shelf. And when you sell, you recapture that bonus depreciation. Am I correct on that, Kyle? Because I've always been a real estate professional.
Well, it can go against your passive income, but it's not going to go against your active. Yeah.
Correct.
And then, yeah, you could use it against the capital gains too. I mean, because you have it just sitting there, but you're then also going to have to pay some of the, the recapture. So it just gets, it's a great tool, but it's not all, there's certain things that can scare people. And then they sometimes end up getting a tax bill that they don't like because they're not aware of it. Where again, we can use certain charitable contributions to offset that in terms of the historical conservation easements, the land conservation easements will offset it because it'll go against that tax bill.
I know one of the struggles that as a general partner, you've got investors that say, can you tell me how much this is going to affect my taxes? How much am I going to be able to write off on my K1s on this? And we can't give that information. Okay?
Right.
Because everybody runs their taxes differently. And when you have different write-offs and gains and all of that, when we come to you, Kyle, and we say, hey, I want to look at these charitable contributions or business interests, could you give us an answer unlike you'd get with cost segregation? Can you tell us exactly, or are we in the same boat?
I can tell you how much we're going to reduce. We can reduce your AGI.
Yeah.
Or give you a general idea. I mean, there's individuals that don't necessarily even know what they're going to make by the end of the year until it's literally the end of the year. That's why, in a sense, business owners, pay quarterlies, and it's an estimate of what you have in your taxes. And I know some people will overpay on their estimates so that they don't have to worry about penalties or anything.
Yeah.
I can give, like I said, I can give you an estimate of what it is. For W-2s, it's pretty easy because you're not going to find very many ways to get deductions. For business owners, it makes it a little more difficult, but it also makes it easier because there's a lot more ways we can create the deductions.
Okay. So Charles Lemire writes 26 US 469 PG, passive loss at disposition. Does that speak language to you, or do we need to get Charles on the line? Charles, tell us what you're saying here.
Well, first of all, my CPA and I have adjoining rooms set up at Leavenworth. So, and there's a lot of debate on this, but essentially at the disposition of a property, I'm a passive, I am not a real estate professional.
Yeah.
I can shuffle the passive losses on the properties that I am buying, all that depreciation, and use it against the gains. And when that happens, the gains release the losses. And so you're able to shuffle the W-2 or the earned income into, you make the earned income go away instead of the gains. So you can either make all of your income go away, or you can make a lot more income and you will be paying a lower rate. And because I'm doing Roth conversions, I'm pulling a lot of money out of one and sticking it in another. So I have a lot of tax, and I end up paying at capital gain rates rather than income rates.
That is something we actually do kind of work on. We're looking at with one of the strategies in terms of what you're saying is to create basically the income losses so that you can do Roth conversions. So I'm somewhat aware. I use my tax specialist for that strategy. So I'd have to talk with them a little more about what you're talking about, Charles.
The one of the tricks or pieces of this puzzle is if you're a real estate professional,
Mhm.
you want to accumulate, or I'm not sure what the word is, but you want to link them all together so that you get your losses all qualified, because some things you're not materially active in. Whereas if you're a passive and you're not a real estate professional, you do not want to link them, because then you are actually disposing of one of them. And each time you dispose of one, you can play this game. And I end up disposing of one at least every year. This year, about 9 of them.
So I'm curious, Charles, why you don't become a real estate professional.
Because nothing I do counts as the time. Other than, I mean, I could go become a GP, but I'm lazy, so I stay as an LP. And the stuff that I do, talking to you, all this stuff doesn't count in those hours.
I think that could be challenged, but I
Well,
get it.
If with them having 87,000 new IRS agents, I'm not going to play that
Yeah.
game. I'm going to be very careful.
There you go. Okay, so Charles, you never think of alternatives, or do you look for alternatives? Do you like this? I mean, because, you know, you want to look at the asset itself. You want to look at what the returns are, but you also want to be with the right team. And if those are not aligned in your time frame, do you look for alternatives?
Well, the comment was made at 700, and although I am pulling over 700 this year, it's in multiple deals, and it's a rare thing that I get. But it's not that rare, but it isn't every year that I would hit 700. So I don't know that some of these techniques would work as well for me as just plain old running the depreciation, with the cost segs and bonus depreciation, and it's 100% this year. That's working pretty well. Doing a opportunity zone, I just did the first one this year, and that's working for, or I feel that it will work for me. The question is, do I have 10 years left? But my family probably does. So therein lies that problem. But so I'm probably doing fine. But as depreciation wanes, the bonus depreciation, then I will have to start looking around for some other stuff.
Yeah. Do any of these sound like of interest to you? Is there
Further
something?
investigation is certainly warranted.
Yeah. Yeah. Awesome. Kyle, for somebody like Charles, what do you see as a great vehicle? I mean, there's all of them, right? But do you have a sense of, he's doing a lot as a passive investor, not a real estate professional. Do you like to go one way or another?
I mean, just kind of on the brief information that he gave, I like the strategic ownership program because of the standpoint that we can allow him to use the cost segregation against his passive income, and then still create a loss for the capital gains utilizing K1. So it just would add more multiple K1s, negative K1s to his tax bill. So when he's filing, so I'd have to get a lot more information. But from what I've heard, I like that option the best because of how he mentioned 700K, which is, that's a really good number for us in terms of the capital gains. And it allows us to create a lot more options for the individual.
Fantastic. I mean, I never knew that any of these things existed. I just thought I was a victim and have done 1031s, as I mentioned, 7 of them. And I don't feel like a victim anymore. This has, been extremely helpful for me, and also bringing awareness to our investors who are on the call. I'd be curious, is there anybody in the house that has used a different strategy like what we're talking about here that has had some success that you'd want to share? Anybody? I'm going to take that as a no.
And Julia, one thing I'd like to say in terms of with the 1031, I've spoken with a lot of brokers about it. They actually like 1031s because there's one broker that I know, it creates forced sales for them. Because they're going to sell the property, they're going to buy another one, so they're going to be on that. And potentially if they bring in both clients with the sales, they now have 4 deals that are done right away. It's guaranteed for them because it has to be done inside that 180 days. Where with these other options, it creates a liquidity event. You can then use it as you please. So right now everyone's hesitant. You're watching in terms of lending, what lenders are giving out because they're not sure about the market. Well, this gives you a chance to sit, see what it's doing, maybe wait 6 more months if you want to, and then start purchasing something because you now maybe have it at a 10% discount, 15% discount. You still have that same cash. Your basis is now restarted and you get the property for less and it's going to cash flow better. The one question some people will say, or their statement that they'll put is, well, now I don't have cash flow while waiting. That's very true. But you may have been able to spend a little bit of that money and still come out far ahead with a 10, 15, 20% discount on the property than you did if you would have exchanged.
Good point. I mean, a lot of people have encouraged me, just sell it. Just get rid of the tick, get rid of the 1031, pay the taxes. You'll make it up on the cost segregation.
And that's, I mean, that's technically not a bad way to look at it. But again, you probably would want to use the cost segregation for the income, especially as a real estate professional. You can offset all your income.
Yes, but I also feel poor when I had 500,000 going into a deal and now I have much less. So
yeah, so that's why we utilize these strategies to help create the liquidity event, and then you get much more depreciation when you do that.
It is amazing. I mean, just amazing vehicles. I'm so appreciative of you being here tonight. Is there anybody in the house that has a question?
I do. I'm sorry, Kyle. How are you? I joined late, but just have a quick question for you.
Yes.
So for the LP investors, they have the passive income, but they do have their active income too with their corporate job and everything. So is there any vehicle, any way to do something with that income? Because I do have a bunch of investors and they're looking for a vehicle, to kind of do some tax write-offs on their active income as well. And the CPAs are telling them they cannot use the cost seg because that's for their passive gain. Whenever they're going to exit the deal, they will have the gain and they can write off against that. So would you recommend anything for this active income? Something could be done?
Anything with charitable contributions, so the land conservation easements, the historical conservation easements, you could have your own private DAF, which I wouldn't necessarily recommend. It doesn't create liquidity for you. The charitable LLC would work if they're on a really high level. Anything with charitable contributions is going to be able to create their deduction as a W-2. That's pretty much the only way that W-2s can actually get deductions. There's other ways you can utilize a retirement account. There's a couple other things, but for the most part, that's really the only way they can get deductions. And when it really looks at it, because I know you're in San Francisco, Vinky. So if you're working with California individuals, you're looking at around 250K of income, for whether it's capital gains income for a California resident, for it to really actually kind of make sense.
That's a great point. Good question, Vinky. Angel says, can they benefit from a deferred sales trust?
Yeah, they can. Thank you, Angel. I actually didn't touch on that, but Section 453 of the tax
Mhm.
code has multiple options. You can utilize installment sales, deferred sales trusts. One that's kind of been heavily looked at lately is a monetized installment sale. There's a group that's has actually changed the name to a dealer something installment sale, dealer facilitated installment sale. And what that is, it's a 30-year deferral. They're known as M453s or 453As. They used to be known as, I think, S453s. But basically, you're utilizing section 453 of the tax code. I don't work a lot with deferred sales trusts, Angel. I know the Cliff Notes version of them. Some of them make me a little hesitant with the fact that some will just have a trustee signing on the managing it. So if it's my hard-earned money, I don't like having someone manage my money. There's also parts where you'll have individuals, they'll have it to where a trustee is signing off in it and you have to sign off on it. Both of you have to sign off on it. I've seen them both ways. Again, it's up to that person, because if that person doesn't sign off on it, you can't do it. And normally their objective is to manage money. It's kind of the same thing that I mentioned with the group that utilizes business insurance to create a deduction. They'll do the strategy for free in a sense, but they want you to write insurance. To me, sure, if the individual wants insurance, that's a great route to go. We create a deduction. It's a deferral for 7 years, but we can plan for that tax down the road. But I don't like the fact that we're writing insurance for the individual just so that they can make the money. It's not the best interest of the client, unless they really want the insurance, then it's great. So yeah, section 453 of the tax code is great.
No, that's great. Now, Charles says a stepfather used a charitable remainder trust when donating to Purdue. It saved his butt. It provided a steady income when the nurses could not steal.
Yeah, because it's in a trust. A lot of times you'll have some form of steady income from it, and then after a period of time, it ends up getting donated. So normally a long period of time, so it can create that income for you that they can't touch because it's in a trust.
And what would be the returns on that?
It varies. A lot of individuals will recommend an annuity where it can be earning 6% on that money, and then you have it set for a certain period of time. So say you have $1 million for 20 years, and with it also accruing 6% interest over time, what you could probably receive $100,000 of income each year.
It's just another vehicle.
Yeah.
All right, Kyle. Just thinking about what Vinky asked, which was active income.
Yeah.
It sounds like you've got options.
Yep.
Or vehicles. And then as well as alternative to investments that you don't want to reinvest as a 1031. So Kyle, how do we get a hold of you? Tell us a little bit more about that.
Yeah, you can always find me on LinkedIn. That's normally the best spot. I will put my email in the chat now that I have my computer running. That you can definitely send me an email, say that you are on Zuminate and would like to hear more about potential options. I always love working with syndicators. I have actually 3 capital groups that I work with where they actually have clients that are high W-2 earners, and they're looking for ways to find them for them to find a little more cash to invest in deals. So, or they actually had one. I got one from a capital group. He sent me 3 individuals that were having 1031s that were having problems finding an exchange. And actually got concerned with their CPA after their CPA said that they couldn't use capital losses from stock as a way to offset the gains, and they had to do a 1031 exchange. That was really concerning to me, because that's actually a really simple way.
Well, wonderful evening to spend with you and learning. Again, this is just the tip of the iceberg. there's so much depth to what you do and what you can help your investors or us. And reach out to Kyle. He's very accessible. He's very generous with his time. And I think that he can lend some information, whether it's for you or your investors, that could be very helpful. So thank you, Kyle. I so appreciate your time with us tonight.